Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today, we're diving into the Northern Lights Variable Fund Trust's report on the TOPS Managed Risk Flex ETF portfolio. I know the name alone sounds like a snooze fest, but trust me, there's some interesting stuff here, especially if you're into how your investments are doing or if you are planning to make investments soon. We're looking at their annual report that covers January to December of 2024. Basically, it tells shareholders like you and me how the fund performed, what it cost, and where your money is actually going. Think of it as a report card, but for your investments. Let's start with the costs. Nobody likes hidden fees, right? This report breaks down how much it costs to invest in this fund. For every $10,000 you put in, it costs about $89 or 0.86%. This percentage is important because it tells you how much of your investment is going towards running the fund rather than growing your money. It's like the overhead of a business, the lower the better. Now, how did the fund actually perform? Well, this report says strong equity performance and smart bond choices led to good returns in 2024. The fund benefited from a booming stock market. Large company stocks like those in the S&P 500 did really well. What is also good is that bonds did better than expected, so it's like a double win that makes this ETF more enticing. To give you a longer view, let's look at how a $10,000 investment would have grown over the past decade. This table shows how the fund performed each year compared to the S&P 500 index, which is often used as a measuring stick. The fund started at $10,000 in 2014, and by the end of 2024, it grew to $13,891. The S&P 500 would have grown to $34,254, so it shows a big difference in growth. Keep in mind this is managed risk, so it will be less volatile and generally result in less gains. It's important to remember that past performance isn't a guarantee of future success, but it gives you an idea of how the fund has handled ups and downs. The S&P 500's performance is there to give you something to compare this ETF to and to show what could be possible had this ETF been more risky. Looking at average yearly returns, over the past year, the fund returned about 6.19%. Over the last 5 years, it averaged 3.13% per year, and over the last 10 years, it averaged 3.34%. Compare that to the S&P 500, which returned 25.02% in 2024, 14.53% on average for the last 5 years, and 13.10% on average for the last 10 years. Now, what exactly is this fund investing in? The fund has about 30 different holdings. The advisory fee paid was $425,776. The portfolio turnover was 14%, so it's changed up somewhat during the year. What portfolio turnover means is that 14% of the investments were replaced throughout the year. The fund is invested in a few main areas. About 82.5% of its money is in exchange-traded funds or ETFs, around 10.8% is in money market funds, and 6.7% is held as collateral for securities lending, which is basically like a safety deposit for borrowed investments. Breaking it down by sector, almost half of the fund is in equity, which means stocks. Around 40% is in fixed income, meaning bonds. About 11.6% is in money market funds, and 7.1% is in collateral for security loans, and about -6.9% are liabilities in excess of assets. So the majority of the fund is invested in both stocks and bonds. The report also lists the top 10 holdings, or where the majority of the money is invested. These include big names like Vanguard S&P 500 ETF, Vanguard FTSE Developed Markets ETF, and Vanguard Short-Term Inflation Protected Securities ETF. It also includes SPDR and iShares ETFs, which are also very well known. Good news, there weren't any big changes to the fund this year. This suggests stability, but of course, things can change quickly in the investment world. Jumping to the financial statements, the fund had investments in securities at cost of about $130.6 million. At value, the investments totaled to about $143.3 million. The fund's total net assets are about $134 million, and it has around 10.6 million shares outstanding. So each share is valued at $12.59. Looking at the income statement, the fund generated a total investment income of about $4.5 million, and after deducting expenses, the net investment income was about $3.3 million. That means that the ETF was profitable to shareholders. The fund saw a net decrease in assets of about $14.2 million. It started the year with $148.2 million and ended with $134 million in assets. This is not great, but also not terrible since the goal is to have managed risk. For the financial highlights, we can see the fund's total return was about 6.19%. Its expense ratio has consistently been 0.86% for the past 5 years. It also had a portfolio turnover of 14%, which shows that the portfolio changed 14% during the past year. Of course, we have to take a look at the important stuff. The financial report explains all its accounting policies, security valuation. We can see that they use a 3-level hierarchy. Level 1 involves looking at prices in markets that the fund can actually use. Level 2 uses observable inputs other than Level 1. Level 3 uses unobservable inputs. Luckily, the fund didn't hold any Level 2 or 3 securities for the year, so this ETF has very transparent holdings. It is the portfolio's policy to continue to qualify as a regulated investment company by complying with the provisions of the Internal Revenue Code. Because the firm follows the IRC, there's no federal tax income required. The fund also discloses its proxy voting policies. What this means is, it tells you how they voted on important company decisions for the companies they invest in. This shows transparency and good governance. So what's the takeaway from all this? The report suggests that this fund is trying to strike a balance between growth and risk. It's not going to shoot the moon like some high-flying tech stock, but it's also designed to protect your money when markets get rough. The fund seems to be performing in line with its objectives, but whether it's the right choice for you really depends on your own risk tolerance and financial goals. One thing to consider is that it heavily weights equity and fixed income. Another thing to consider is that because it does have managed risk, you aren't going to see super high growth compared to an S&P 500 ETF. Overall, the TOP's Managed Risk Flex ETF portfolio appears to be a stable, well-managed fund with a focus on balancing risk and return. While it may not be the highest performer, its emphasis on downside protection could make it an attractive option for risk-averse investors. Thanks for watching, and don't forget to like, comment, and subscribe for more corporate decoding. Let me know in the comments which filing I should break down next.